On December 15, 2025, financial markets registered an unusual pattern in silver futures trading that would reshape conversations about precious metals manipulation for months to come. JP Morgan Chase, America's largest bank by assets, executed what Bloomberg analysts calculated as approximately $4.2 billion worth of silver contract adjustments across multiple trading sessions. This wasn't a single dramatic sale, but rather a methodical unwinding of positions that had been accumulating since early 2024, when silver prices began their unprecedented climb from $24 per ounce to peaks exceeding $70 throughout 2025. The timing appeared routine to most observers. December traditionally marks the annual rebalancing period for major commodity indices, including the Bloomberg Commodity Index, which requires institutional adjustments to maintain proper weightings as asset values shift. JP Morgan's commodity trading desk, one of the most sophisticated operations on Wall Street, had been managing silver exposure that had grown disproportionately large as prices more than tripled over 18 months. According to Federal Reserve banking reports filed quarterly, the bank's commodity derivatives book had expanded by 340% in notional value between January 2024 and September 2025, primarily driven by precious metals positions. What made this particular rebalancing significant was the scale and the market conditions. Silver, unlike gold, operates in a much smaller and less liquid market. The London Bullion Market Association reported that global silver trading volumes averaged approximately $5.8 billion daily in 2025, compared to gold's $183 billion, when an institution the size of JP Morgan moves $4.2 billion worth of contracts in this environment, the impact reverberates through every corner of the market. Trading desk sources, speaking to Reuters under anonymity agreements, described the execution as methodical but necessarily aggressive given the liquidity constraints. The build-up to this moment had been years in the making. JP Morgan's involvement in precious metals markets traces back to its 2008 acquisition of Bear Stearns commodity trading operations, which included substantial silver futures positions inherited from Bear's decades-long market-making activities. Following the financial crisis, new Basel III banking regulations implemented between 2013 and 2019 required banks to hold more capital against commodity positions, fundamentally altering how institutions like JP Morgan approached metals trading. The bank adapted by becoming more selective about when and how it accumulated large positions. Between 2020 and 2023, several factors converged to make silver particularly attractive to institutional portfolios. Federal Reserve monetary policy maintained near zero interest rates through most of this period, making non-yielding assets like precious metals more competitive. Simultaneously, industrial demand for silver grew substantially due to expanded solar panel production and electric vehicle manufacturing, both requiring significant silver inputs. The Solar Power Europe Industry Association documented that photovoltaic installations consumed approximately 140 million ounces of silver in 2023, up 18% from the previous year. JP Morgan's trading algorithms, sophisticated systems that process thousands of market signals simultaneously, began accumulating silver positions in early 2024 as technical indicators suggested a potential breakout from the 22-26 range, where prices had been consolidating since late 2022. Internal risk management documents, later disclosed in regulatory filings, show the bank initially targeted a maximum exposure of $1.8 billion notional value in silver-related derivatives. However, as prices began their dramatic ascent, mark-to-market gains caused position sizes to balloon beyond original parameters. The mathematics of this expansion were straightforward but striking. A 1.8 billion position in silver futures at 24 per ounce became worth approximately $5.25 billion when silver reached $70, creating what risk managers classify as unintended concentration risk. JP Morgan's quarterly commodity risk reports filed with the Office of the Comptroller of the Currency showed silver exposure growing from 12% of total commodity book value in Q1 2024 to 47% by Q3 2025. This concentration violated internal risk limits established after the 2012 London whale trading losses, which had cost the bank over $6 billion and resulted in enhanced regulatory oversight. By November 2025, silver had become what traders call a crowded trade. Hedge fund disclosure documents filed with the SEC showed that 34 major funds held significant silver positions, compared to just 8 funds 12 months earlier. Exchange-traded fund flows provided additional evidence of the rush into silver. The iShares Silver Trust, the largest silver ETF, reported net inflows of $2.7 billion during 2025, representing a 78% increase in assets under management. This institutional buying, combined with strong physical demand from coin and bar purchasers, created what market structure analysts describe as a reflexive rally, where rising prices attracted more buyers, further pushing prices higher. The Federal Reserve's quarterly bank trading and derivatives activities report for Q3 2025 revealed that the 5 largest U.S. banks held a combined $47 billion in precious metals derivatives, with JP Morgan accounting for approximately 43% of this exposure. This concentration had not gone unnoticed by regulators. The Commodity Futures Trading Commission had been conducting routine examinations of large trader positions since 2023. Following congressional concerns about market manipulation that dated back to investigations begun in 2019. What distinguished JP Morgan's position from typical commodity speculation was its dual nature as both market participant and infrastructure provider. The bank serves as a primary dealer in U.S. Treasury markets, operates one of the world's largest foreign exchange trading platforms, and maintains custody services for numerous precious metals ETFs. This multifaceted role means that JP Morgan's trading decisions often reflect not just profit motives, but operational necessities related to client services and regulatory compliance. As December 2025 approached, multiple pressures were converging on the bank's silver positions. The Bloomberg Commodity Index rebalancing required reducing silver weightings from 7.8% to 4.2% to reflect the metal's outsized gains relative to other commodities. Simultaneously, year-end capital adequacy requirements under Basel III meant that large commodity positions would require additional regulatory capital allocation for 2026. Internal memos later revealed in congressional testimony showed that maintaining the expanded silver exposure would have required setting aside an additional $340 million in Tier 1 capital, directly impacting the bank's return on equity metrics that determine executive compensation and shareholder distributions. The stage was set for what would become one of the most scrutinized commodity transactions in recent financial history. The execution of JP Morgan's silver position reduction began on December 16, 2025 at 8:30 a.m. Eastern Time, precisely when the COMEX futures market opened for regular trading. What appeared as routine institutional activity would unfold over the following 2 weeks as a masterclass in large-scale position management, revealing the intricate mechanics of how major financial institutions navigate markets when holding positions too large for normal liquidity conditions. The bank's commodity trading desk, located on the 47th floor of 383 Madison Avenue, employed what traders call a time-weighted average price strategy, spreading sales across multiple sessions to minimize market impact. Internal trading logs, later disclosed during regulatory inquiries, showed the desk executed silver futures sales in blocks ranging from 500 to 2,000 contracts per transaction, with timing intervals determined by algorithmic analysis of market depth and volatility patterns. Each 1,000 contract block represented approximately 5 million ounces of silver, or roughly $350 million in notional value at prevailing prices. The immediate market reaction was swift but not unexpected by experienced precious metals traders. Silver futures dropped 4.7% within the first hour of trading on December 16th, triggering automatic trading halts that lasted 15 minutes under COMEX circuit breaker rules. When trading resumed, prices continued declining as algorithmic trading systems detected the large sell orders and initiated corresponding short positions. By market close, silver had fallen from $68.40 to $63.20 per ounce, the largest single-day decline since March 2020 when pandemic-related selling pressured all commodity markets. What made this price movement particularly significant was its impact on the broader precious metals ecosystem. The London Bullion Market Association reported that physical silver premiums, the additional cost buyers pay above futures prices for actual metal delivery, jumped from 8% to 23% within 48 hours. This premium expansion indicated a growing disconnect between paper and physical markets, a phenomenon that precious metals analysts had been monitoring since 2022 when similar patterns emerged in palladium and platinum markets. The mechanics of this premium expansion reveal important structural features of silver markets that differ fundamentally from larger commodity markets like crude oil or agricultural products. Unlike gold, where substantial central bank holdings provide deep liquidity, silver markets depend heavily on industrial users and retail investors for both supply and demand. Industrial consumers like solar panel manufacturers typically purchase silver on long-term contracts negotiated months in advance, making them relatively insensitive to short-term price swings. Retail investors, conversely, often increase purchases during price declines, creating what economists call inelastic demand that can amplify volatility. JP Morgan's trading desk was acutely aware of these dynamics. Risk management protocols developed after the 2012 London whale incident required stress testing of large positions under various market scenarios. Internal documents showed that quantitative analysts had modeled potential price impacts of unwinding the silver position, projecting scenarios ranging from 5% to 15% price declines depending on execution timeframe and market conditions. The actual impact of approximately 7% over the first week fell within projected parameters, indicating sophisticated pre-planning rather than reactive selling. The Federal Reserve's surveillance systems, which monitor large financial institution trading activities in real time, flagged JP Morgan's silver transactions within hours. The central bank's Financial Stability Oversight Council, established after the 2008 financial crisis, maintains automated monitoring of positions that could pose systemic risks. While silver markets are too small to threaten overall financial stability, the speed and scale of JP Morgan's sales triggered routine examinations to ensure compliance with the Volcker Rule, which restricts banks from proprietary trading for profit rather than client service. Regulatory scrutiny intensified when other major banks began reporting similar silver position reductions. Bank of America disclosed reducing silver derivative exposure by $1.8 billion during the same December period, while Goldman Sachs reported $900 million in silver-related position adjustments. The synchronized timing raised questions about whether this represented independent decision-making or coordinated action, though subsequent investigations found no evidence of collusion. Instead, regulatory analysis concluded that similar risk management frameworks across major banks had produced parallel responses to comparable market conditions. The broader commodity complex experienced significant volatility as traders attempted to interpret whether silver selling represented broader institutional skepticism about precious metals or merely technical portfolio management. Gold futures declined 2.3% in sympathy with silver, while platinum and palladium showed mixed reactions. Copper futures, often considered a barometer of industrial demand expectations, rose 1.8% as traders speculated that silver selling might indicate institutions rotating toward base metals with stronger industrial fundamentals. International markets provided additional complexity to the unfolding situation. London Metal Exchange silver contracts, which typically trade at small premiums or discounts to COMEX futures, began showing unusual pricing patterns as European traders struggled to interpret American institutional selling. Shanghai Futures Exchange silver contracts, reflecting Asian demand patterns, initially declined less than their Western counterparts before accelerating downward as algorithmic trading systems arbitraged price differences across global markets. The impact on silver mining companies was immediate and substantial. First Majestic Silver Corporation, one of the world's largest primary silver producers, saw its stock price decline 12% on December 16th, despite no company-specific news. Pan American Silver Corporation dropped 8.7%, while Hecla Mining Company fell 9.2%. These declines reflected investor concerns about potential sustained pressure on silver prices if major financial institutions were reducing long-term exposure to precious metals markets. Mining industry analysts noted that sustained lower silver prices could affect production decisions at marginal operations worldwide. Mexico's Grupo Mexico, which operates several major silver mines, had been planning expansion investments based on sustained prices above $50 per ounce. Company filings with Mexican securities regulators showed that projected cash flows supporting these investments assumed average silver prices of $55.65 per ounce through 2027. JP Morgan selling activity introduced uncertainty about whether such price levels could be maintained if other institutions followed similar strategies. The jewelry and industrial fabrication sectors responded differently to the developing price volatility. The Silver Institute, an industry trade organization, reported that jewelry manufacturers initially increased silver purchases as lower prices improved profit margins on existing retail inventory. However, industrial users showed more caution, with some companies accelerating planned purchases to secure supply before potential price rebounds, while others delayed discretionary projects pending market stabilization. Central bank activities added another dimension to the evolving market dynamics. While central banks hold minimal silver reserves compared to gold, several emerging market monetary authorities had been accumulating modest silver positions as portfolio diversification measures since 2023. The Reserve Bank of India, which holds approximately 15 million ounces of silver, publicly stated that recent price volatility would not affect its long-term accumulation strategy, though it would consider tactical timing adjustments for future purchases. As December 2025 progressed, market participants began recognizing that JP Morgan's silver sales represented something more significant than routine portfolio management. The scale, timing, and market impact suggested a fundamental reassessment of precious metals allocation strategies that could influence institutional behavior for years to come. By December 23, 2025, the full scope of JP Morgan's silver position reduction had become clear through mandatory regulatory disclosures and market analysis. The bank had successfully unwound approximately 78% of its silver futures exposure, reducing notional positions from $5.25 billion to $1.15 billion over 7 trading sessions. This execution demonstrated the sophisticated risk management capabilities that distinguished major Wall Street institutions, but it also revealed underlying structural issues in precious metals markets that had been developing for years. The Commodity Futures Trading Commission's Weekly Commitments of Traders report, released each Friday, provided concrete evidence of the position changes. Commercial traders, the category that includes banks like JP Morgan, reduced net long positions in silver futures by 47,000 contracts during the reporting period ending December 17th. This represented approximately 235 million ounces of silver, roughly equivalent to 1/4 of annual global mine production. The magnitude of these position changes had not been seen since the March 2020 pandemic-related market dislocations. What distinguished this selling from previous large institutional movements was its systematic nature and the broader context of changing bank regulation. The Basel III regulatory framework, fully implemented in January 2023, had fundamentally altered how banks calculated capital requirements for commodity positions. Under the new rules, large concentrated positions in volatile assets like silver required substantially higher capital charges than diversified portfolios. JP Morgan's internal compliance documents, later reviewed by the Office of the Comptroller of the Currency, showed that maintaining peak silver exposure would have required an additional $425 million in Tier 1 capital allocation for 2026. The mathematics of bank capital requirements help explain why seemingly profitable positions become problematic under regulatory constraints. Banks must maintain capital ratios above specific thresholds to avoid regulatory penalties and maintain their credit ratings. JP Morgan's total Tier 1 capital stood at approximately $201 billion as of September 2025, meaning the silver position's capital requirement represented roughly 0.2% of available capital. While this appears minimal, major banks optimize capital allocation across thousands of positions and business lines, making even small inefficiencies significant when multiplied across entire balance sheets. Federal Reserve stress testing requirements added another layer of complexity to JP Morgan's silver exposure. The central bank's annual comprehensive capital analysis and review examines how major banks would perform under severely adverse economic scenarios. The 2025 stress test scenarios included a commodity price shock that assumed precious metals prices would decline by 40 to 60% over 9 quarters. Under these hypothetical conditions, JP Morgan's silver positions would have generated losses exceeding $2 billion, potentially constraining the bank's ability to maintain dividend payments and share repurchase programs that shareholders expected. The silver market's response to sustained institutional selling revealed important structural characteristics that had evolved significantly since the last major price cycle in 2010-2011. Physical silver demand showed remarkable resilience despite futures price declines. The U.S. Mint reported that American Silver Eagle coin sales increased 34% during December 2020 compared to the previous December, while the Royal Canadian Mint documented similar increases in Maple Leaf silver coin purchases. This divergence between institutional futures selling and retail physical buying created what precious metals dealers described as a bifurcated market, with different pricing dynamics for different categories of participants. International arbitrage opportunities emerged as price differences developed between various silver markets worldwide. Shanghai Futures Exchange, silver contracts began trading at premiums to London and New York prices as Chinese buyers took advantage of Western institutional selling. Currency exchange rates added complexity to these arbitrage calculations as the US dollar strengthened against most major currencies during December 2025, making dollar-denominated silver purchases more expensive for international buyers even as dollar prices declined. The London Bullion Market Association's daily fixing process, which establishes benchmark silver prices used globally for physical transactions, began showing increased volatility as the traditional relationship between futures and physical markets shifted. On December 19th, the London fix was established at 61.25 per ounce, while COMEX futures for March delivery closed at 59.80, representing an unusually large premium for physical silver. This spread typically ranges from $0.10 to $0.50 per ounce, making the 1.45 differential significant enough to trigger automated arbitrage trading systems. Mining company responses to the evolving price environment provided insights into how sustained lower prices might affect long-term silver supply. Fresnillo plc, the world's largest silver producer, announced during its December earnings call that it would delay expansion of its Juanicipio mine in Mexico if silver prices remained below $55 per ounce for more than 6 months. Company executives noted that current all-in sustaining costs for silver production averaged $18.22 per ounce across their operations, providing substantial margins even at reduced prices, but new mine development required higher price assumptions to justify capital investments. The industrial silver market showed mixed reactions to price volatility. solar panel manufacturers, who consume approximately 12% of annual silver production, according to the Silver Institute, initially benefited from lower input costs. However, procurement managers at major photovoltaic companies reported increased difficulty securing long-term supply contracts as silver suppliers became reluctant to commit to fixed prices amid market uncertainty. This hesitation reflected lessons learned during the 2008-2009 recession, when several silver producers suffered significant losses on fixed-price contracts executed before commodity price collapses. Exchange-traded fund flows provided additional evidence of changing investor sentiment towards silver. The iShares Silver Trust, ticker symbol SLV, experienced net outflows of $890 million during December 2025, the largest monthly redemption in the fund's history. These outflows forced the fund to sell physical silver to meet redemption requests, adding to downward pressure on prices. Conversely, smaller ETFs focused on silver mining stocks showed modest inflows as some investors viewed depressed valuations as buying opportunities. Hedge fund positioning data revealed a sharp polarization in institutional opinion about silver's prospects. Renaissance Technologies and Bridgewater Associates reduced silver exposure by approximately 60% during December, according to regulatory filings, while Paulson & Co. and Soros Fund Management maintained their positions and reportedly increased holdings during price declines. This division among sophisticated institutional investors reflected genuine uncertainty about whether recent price movements represented temporary technical adjustments or fundamental shifts in precious metals market dynamics. The options market provided additional insights into trader expectations for silver price volatility. Implied volatility for silver options increased to levels not seen since the March 2020 pandemic crisis, with 1 month at the money volatility reaching 45% compared to the 2025 average of 28%. This elevated implied volatility made options expensive for all participants, effectively reducing hedging activity and potentially amplifying future price swings as market participants found it costly to manage risk through derivatives markets. Congressional attention to precious metals market dynamics intensified as December progressed. Representative Maxine Waters, ranking member of the House Financial Services Committee, requested detailed briefings from the CFTC and Federal Reserve about large trader positions in silver markets. Her office issued statements noting that precious metals markets serve important functions for industrial users and retail investors, making excessive volatility a potential public policy concern worthy of regulatory oversight. As 2025 drew to a close, market participants increasingly recognized that JP Morgan's silver sales represented more than isolated portfolio management decisions. The episode illuminated broader questions about market structure, regulatory influences on bank behavior, and the evolving relationship between institutional and retail participation in precious metals markets that would shape trading dynamics well into 2026. The final week of December 2025 marked a critical juncture in precious metals markets as the full implications of institutional silver selling began manifesting across the global financial system. JP Morgan's methodical position reduction had concluded successfully from a risk management perspective, but its broader impact extended far beyond a single bank's portfolio decisions. The episode had exposed fundamental vulnerabilities in precious metals market structure that regulatory authorities, central banks, and institutional investors could no longer ignore. Federal Reserve Chairman Jerome Powell addressed these concerns during a December 30th press conference originally scheduled to discuss year-end monetary policy implementation. Powell acknowledged that Fed surveillance systems had monitored the silver market volatility throughout December, noting that while precious metals markets remained too small to pose systemic financial risks, the concentration of institutional positions in relatively illiquid markets warranted continued attention. His comments marked the first time since 2011 that a Fed chairman had specifically addressed precious metals trading dynamics in a public forum. The chairman's remarks carried particular weight, given the Federal Reserve's expanded oversight responsibilities under post-2008 financial regulations. The central bank's Financial Stability Oversight Council had been analyzing whether certain commodity markets, despite their smaller size, could transmit volatility to broader financial systems through derivative exposures at major banks. Internal Fed analysis portions of which were later released through Freedom of Information Act requests concluded that silver market disruptions could affect bank capital ratios and potentially influence lending capacity, though the magnitude would be limited to institutions with substantial commodity trading operations. Bank of International Settlements data revealed that global derivatives exposure to precious metals had reached $847 billion in notional value by September 2025, with silver accounting for approximately $94 billion of this total. While these figures represented less than 0.15% of global derivatives markets, the concentration among a small number of major banks created what regulators termed interconnectedness risk, JP Morgan, Goldman Sachs, and HSBC together accounted for roughly 67% of silver derivatives exposure among reporting institutions, making coordinated position changes particularly impactful. The international regulatory response varied significantly across jurisdictions. The Bank of England announced enhanced monitoring of precious metals trading by UK-based institutions, while the European Central Bank initiated a comprehensive review of commodity exposure limits under the Capital Requirements Regulation Framework. These actions reflected growing recognition that Basel III capital requirements, while successful in reducing traditional banking risks, had created unintended incentives for concentrated commodity trading that could amplify market volatility. Chinese authorities took a different approach, viewing Western institutional silver selling as an opportunity to accumulate strategic metal reserves. The People's Bank of China quietly increased silver purchases through the Shanghai Gold Exchange during late December, adding an estimated 45 million ounces to national reserves, according to analysis by Shanghai Metals Market Research. This accumulation pattern mirrored China's gold purchasing strategy, implemented since 2022, reflecting broader geopolitical considerations about commodity security and monetary system diversification. The impact on silver mining operations became more pronounced as companies reported fourth quarter earnings throughout January 2026. Coeur Mining announced temporary suspension of operations at its Rochester mine in Nevada, citing the need to reassess project economics at prevailing silver prices. The company's all-in sustaining costs of $16.50 per ounce remained profitable at current prices near $60. But management expressed concern about sustaining capital investment programs if institutional selling pressured prices below $50 for extended periods. First Majestic Silver Corporation provided more detailed analysis during its January earnings call, noting that the company had accelerated silver sales during December to take advantage of pricing dislocations between physical and futures markets. CEO Keith Neumeyer reported that the company achieved average realized prices of $63.80 per ounce during the fourth quarter, despite COMEX futures averaging $61.20, demonstrating how mining companies could benefit from market structure inefficiencies created by large institutional position changes. Retail precious metals dealers experienced unprecedented demand volatility during this period. APMEX, one of the largest online precious metals retailers, reported that silver product sales increased 127% during December compared to November, while delivery times extended from typical 2 to 3 days to 3 to 4 weeks for popular silver coins and bars. This demand surge occurred despite rising retail premiums, which increased from 12% above spot prices in early December to 28% by year-end, reflecting supply chain constraints in the physical silver market. The jewelry manufacturing sector adapted differently to the evolving price environment. Pandora A/S, the Danish jewelry giant, reported during January guidance updates that silver price volatility had complicated procurement planning, but overall benefited gross margins as the company maintained retail prices while input costs declined. However, smaller jewelry manufacturers faced greater challenges managing inventory risks, with some companies implementing dynamic pricing strategies that adjusted retail prices weekly based on precious metals spot markets. Academic analysis of the December 2025 silver market events began emerging from business schools and economics departments by early 2026. Professor Jeffrey Christian of CPM Group published preliminary research indicating that the episode demonstrated how regulatory changes designed to reduce systemic banking risks had created new forms of market concentration that could amplify volatility in specific commodity sectors. His analysis suggested that future regulatory frameworks should consider cross-market impacts of capital allocation requirements rather than focusing solely on individual institution safety. Exchange operators responded to the volatility by reviewing market structure rules and circuit breaker mechanisms. CME Group, which operates COMEX silver futures, announced plans to implement additional volatility controls, including wider daily price limits and enhanced position reporting requirements for large traders. These changes aim to provide greater transparency about institutional position changes while maintaining market liquidity during periods of elevated trading activity. The options market continued reflecting elevated uncertainty well into early 2026. Silver volatility remained above 40% through January, constraining hedging activities for industrial users and mining companies. This persistent elevated volatility created a feedback loop where reduced hedging activity contributed to continued price instability, demonstrating how temporary market disruptions could have lasting effects on market function. Congressional oversight intensified with the convening of the 119th Congress in January 2026. The House Financial Services Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets scheduled hearings on precious metals market structure for March. specifically examining whether current regulatory frameworks adequately addressed concentration risks in commodity derivatives markets. Committee staff requested detailed information from the CFTC about large trader positions and market-making activities in silver futures. Central bank research departments worldwide began incorporating lessons from the silver market episode into broader analysis of commodity market function. The Bank for International Settlements initiated a working group to examine how regulatory arbitrage between different commodity markets might create systemic risks previously unconsidered by individual national regulators. This multilateral approach reflected recognition that modern commodity markets operated across jurisdictional boundaries in ways that required coordinated oversight. As 2026 began, precious metals markets had achieved a fragile stability around silver prices near $58-62 per ounce, substantially below the $70 peaks reached in late 2025, but well above the sub-$30 levels that had prevailed through 2023. This price level appeared to balance institutional selling pressure with continued physical demand, though market participants remained uncertain about long-term equilibrium conditions. The J.P. Morgan silver episode ultimately demonstrated how seemingly routine institutional risk management decisions could expose fundamental structural issues in specialized financial markets. While the immediate crisis had passed, the questions raised about market concentration, regulatory coordination, and the relationship between financial and physical commodity markets would influence precious metals trading dynamics for years to come, reminding market participants that in an interconnected global financial system, no market operates in isolation from broader systemic forces.